All right, let's talk about something that every single Canadian investor has to deal with. But let's be honest, most of us kind of dread it, taxes on our investments. It can really feel like you're trying to navigate a maze, right? But trust me, once you know the path, you get to keep a whole lot more of your hard-earned money. So let's pull back the curtain and make this whole thing simple. So you've made some great moves in the market. Your portfolio's starting to look pretty good, and you're feeling on top of the world. But then that little voice creeps in, doesn't it? Uh-oh, what do I owe the tax man? Well, that is exactly what we're going to figure out today. We're going to break this down into 6 easy-to-digest parts. We'll start with the 3 ways you can earn money from investments. Then, why the type of account you use is so important. We'll touch on the special rules for U.S. stocks, decode those confusing tax slips you get, cover some really smart tax-saving strategies, and we'll wrap it all up with the one golden rule you need to remember. Let's do this. Okay, first things first. Pretty much every single dollar you make from investing is going to fall into one of 3 buckets. And here's the kicker. Each bucket is taxed in a totally different way. Getting this down is the foundation for everything else we're going to talk about. So the most common one you'll hear about is a capital gain. It's really simple. It's just the profit you make when you sell an investment. Now, the key word there, and I mean the key word, is sell. If you buy a stock and it doubles in value, that's awesome, but it's just on paper. You don't actually owe a dime in tax until you hit that sell button and realize the gain. So what's this 50% all about? Now, this is crucial. It is not a 50% tax. No way. It's actually much better. It means that only half of your profit is taxable. So on that $1,000 gain from before, only $500 actually gets added to your income for the year. This is what makes capital gains the most tax-friendly way to make money investing in Canada. Next up, we've got dividends from Canadian companies. Now, these are special. They get this really nice treatment because of something called the dividend tax credit. Just think of it like this. The company already paid corporate tax on its profits before sending you that dividend. So this credit is basically the government's way of saying, hey, we're not going to tax that same dollar at the full rate all over again. It's a sweet deal, but remember, it only counts for dividends from Canadian companies. And our final bucket is interest income. This is the stuff you earn from GICs, bonds, or even that high-interest savings account. And there's no fancy footwork here, no special credits or anything. 100% of the interest you earn gets added right on top of your income and is taxed at your regular marginal rate. Plain and simple, it's the least tax efficient of the 3. Okay, so we've got our 3 types of income sorted, but now we have to talk about what is honestly the single most important piece of this entire puzzle, the type of account you're actually investing in. This one thing can completely change the game. And here it is. This is the crucial distinction. You see, everything we've just discussed, the capital gains tax, the dividend credits, that only applies if you're investing in a taxable account, sometimes called a cash or margin account. If you're investing inside a registered account, like a TFSA or an RRSP, well, it's a whole different world. In there, your money grows completely tax-free. No tax on capital gains, no tax on dividends. It is a massive advantage. Now let's dive into something that trips up a lot of Canadian investors, holding U.S. stocks. For the most part, the rules are the same, but there are a few extra wrinkles you've got to know about, especially when it comes to those U.S. dividends. Okay, you're going to want to pay close attention to this one. Because of a tax treaty, if you hold U.S. stocks in an RRSP, those dividends are totally tax-free. Beautiful. But in a TFSA, the IRS actually withholds 15% of the dividend before it even gets to you. Same thing for a taxable account. It's a 15% withholding tax. But there's a huge catch. You must have a form called the W-8-BEN on file with your broker. If you don't, that tax jumps from 15% all the way up to 30%. So a quick phone call to your brokerage to make sure that form is filled out can literally save you hundreds or thousands of dollars. And speaking of forms, there's one more piece of paperwork to be aware of. If the total cost of all your foreign investments in your taxable accounts goes over 100,000 Canadian dollars at any point during the year, you have to file a Form T1135 with the CRA. It's not a tax form, it's just a declaration, but it is absolutely mandatory. All right, enough with the theory, let's get down to brass tacks. When tax season rolls around, your brokerage is going to start sending you some documents. Let's figure out what these things are and what they actually mean, so you're not just staring at a bunch of boxes and numbers. So, did you hold any ETFs, REITs, or mutual funds in your taxable account this year? If you did, you're going to get something called a T3 slip. See, these kinds of investments are usually structured as trusts, and the T3 basically breaks down all the different kinds of income: dividends, interest, capital gains that the fund paid out to you. Just a heads up, these tend to show up a little later, usually sometime in March.
Okay, what if you own individual stocks or bonds instead?
Well, in that case, you'll be getting a T5 slip. This one's a lot simpler. It just lays out the dividend and interest payments you got directly. You can usually expect this one to land in your mailbox sometime in February. And finally, what about those capital gains we talked about? How do you actually report the sales you made? For that, you'll get a T5008 slip. This form lists every single sale you made during the year. It's the document you'll use to calculate all your gains and losses. Oh, and here's a pro tip. If you earned less than $50 in dividends or interest, you probably won't get a T3 or a T5, but you are still legally required to report that income, the CRA knows. And now for the really fun part. You know, knowing the rules is one thing, but using them to your advantage, that's where you can really make a difference. Let's look at a few smart and totally legal strategies to minimize your investment tax bill. This one is a biggie. It's called tax loss harvesting. Let's say you sold a winning stock for a nice gain. Well, if you have another investment that's down in value, you can sell it to create a capital loss. And then you can use that loss to wipe out the gain from your winner, basically reducing your taxable income to zero. And what's really cool is that if your losses are bigger than your gains, you can carry them back 3 years to get a refund, or carry them forward forever to use against future gains. It's incredibly flexible. But, and this is a huge but, there's a trap you have to avoid called the superficial loss rule. To stop people from gaming the system, you are not allowed to sell an investment for a loss and then immediately buy it back. You or your spouse, that's important, have to wait for a 30-day period to pass before you can buy it again. If you break that 30-day rule, the CRA just says, nope, sorry, and your loss is denied. A popular workaround is to sell your losing stock and then immediately buy similar but not identical ETF from a competitor. That way you stay invested, but you still get to claim the loss. Here are 2 more quick pro tips for you. First, timing is everything. If you sell a winning stock in early January instead of late December, you don't have to pay the tax on that gain for another whole year. It's a simple way to defer your tax bill. Second, be super careful when moving money to your RRSP. If you have a stock that's sitting at a loss in your taxable account, sell it first, claim that capital loss, and then move the cash into the RRSP. If you just transfer the stock directly, that's called an in-kind transfer, you are not allowed to claim that capital loss. It just, poof, vanishes. Okay, we have been deep in the weeds with a lot of technical stuff, but I want to finish up by zooming out and talking about the single most important piece of advice that puts all of this into perspective. You'll hear this phrase a lot from seasoned investors. Don't let the tax tail wag the dog. And what it means is this. Yes, you should absolutely be smart about taxes. Use these strategies, save money. But minimizing tax should never, ever be your number one goal. Your first priority is always to make a good investment decision. Tax planning is a very, very important second step. So now that you've got the lay of the land, what's one small thing you can actually do? Could you take 2 minutes to call your broker and just confirm that W-8 Ben form is on file? Maybe you could put a reminder in your phone for early December that just says, look for tax loss selling opportunities. Taking one small, simple action is how you turn all this knowledge into real money in your pocket. Thanks for tuning in.